Oh, very good day, Ken. Pleasure to catch up with you again. We're obviously part of our free content on YouTube. So how are you?
Morning, Paul, and welcome to everybody. We are back here again. It's a new week, and boy, it is. Has there been some interesting things that have happened, especially financially, going back to Friday, starting with the jobs report. Then we move into the absolute bloodbath that was the global markets yesterday, and it seems today that it's as if nothing had happened. But there's a lot of things in between I know we need to address and touch upon. So, how about we start first with Friday with the jobs report, the revisions, and it really appears that the Fed is behind the curve once again, and that probably we've been in recession for quite a while. Only some of the numbers, the true numbers, are starting to come to the surface.
Yeah, absolutely. So do you want to fill everyone in, so to speak, with the jobs data?
Yeah, the job data came out Friday. First, it was, I don't have the exact numbers right in front of me, but they were well below expectations. The unemployment rate shot up to, I believe, 4.3%.
Yes, they did.
Then we had a lot of revisions for the months before. Now, most people who have been paying attention have been realizing, at least for the last 6 to 12 months, that the administration, the BLS that puts out these things, has been fudging the numbers so great that every single time, every single month, they have beaten the analysts' expectations. And at the same time, the next subsequent months, we've seen massive revisions. So the birth death model, where they create these artificial numbers out of thin air to try to justify jobs, that really has been keeping, for all intents and purposes, the Fed, who should know better that these job numbers and the unemployment rate were fudged, but it's been keeping the Fed from actually doing some real policy making, monetary policy making, to deal with what appears to be a recession. Now, the reason I say recession is because if you go back at least 6 months, there's 50 different hard and soft data points with manufacturing, with PPI, with uh, durable goods, you name it, from all across the country that have been below the 50 point. And the 50 point on their graphs, anything below is decline, anything above is growth. And for the most part of this year, we have been in decline. So take in, and then of course you take into consideration the bond markets, the inversion of the 2 year and the 10 year, which is always indicative leading into a recession. And now that yield curve is steepening, going back to where the 10 and the 2 are nearly equal. That usually says we're well into a recession. So all the indicators have said this, but the Fed has been relying upon the jobs numbers more than anything. And those job numbers have been incorrect, manipulated, and just for political purposes. So now we're starting to see some of the repercussions of this, where the stock market's at all-time highs for based on what the Fed's going to do, because ever since 2011, 2012, nothing in the equity markets is done based on real fundamental data. It's follow the Fed. And we saw this, of course, we'll get into Monday, where after last week's FOMC, where, well, we're not going to do anything, but we're watching the data. And maybe in September we'll do a quarter point, maybe not. But the markets are in chaos because they have no real clear direction where they're going. And I think we're going to see a lot more volatility going forward.
Yeah, I mean, obviously, as you said, we'll discuss some of the data or things that happened, obviously, on Monday. But what's interesting is, and we'll come on to some of the reasons or why we think what's happened, was the fact that if the belief was that you're going to cut interest rate, then that's not a reason why the Dow, for example, would fall over 1,000 points. But it's ironically just how badly manipulated equity markets are, that in hiking interest rates, equity markets should not have risen to all-time highs. So as usual, the reverse often happens of what should happen. And that's just one example of that. I mean, for me, looking at the jobs data in of itself, yes, okay, it was a shocking miss, but we've seen shocking misses before. We've never had this kind of reaction we subsequently had. So for me, it was very clearly for some entirely different reason. But masquerading as well is there's a fear that we're going to go into recession. I mean, that very conveniently plays into knocking gold and by extension silver. How very convenient, and continuing to do so yesterday and obviously today. But clearly, at least from my perspective, there was no reason to have such a violent reaction to jobs data. I mean, if it never happened before, then you would tend to sit there and go, well, okay, then maybe that isn't a surprising reaction. But also, it's worth mentioning at this point how in recent months and weeks, a lot of high net worth individuals and investors have been dumping stocks. Well, is that indicative of a feeling of something else that needs to be considered? We see a raft of data that supports the opinion that a recession, well, did we ever get out of a recession? This has always been one of my major bugbears with all financial data. But if you look at in the United States, the labor force that's unemployed 15 weeks or over, this is the official data, which is, of course, in reality, significantly worse. That's the U1. It's very telling that figure has been rising, started to rise again. Obviously, it spiked during COVID. What a surprise. Then it fell away. Now it starts to spike. And every time it starts to spike, you always historically get a recession. And that's going back to recessions they had in prior to the 50s, in the 50s, the 60s, 70s, 80s, etc., etc. So, okay, maybe this time we buck the trend, or maybe we don't. But there is all this raft of data that supports that view, but I don't believe the market reaction related specifically to that data. I think that was just a very convenient way of masking some far bigger issue, and which is why we subsequently saw what we saw.
Yeah, there's always a delimiter or a catalyst, something foundation for the global economy, or I don't want to say the economy, but the global market system, global financialization. In the 80s, when the US, I forget the legislation they passed, pretty much to put the screws on Japan. Japan was taking over much of America. The US was still just barely coming out of the recession from the 70s and the Reagan voodoo economics. But when they did this, they affected the currency, and it started something in the late 80s known as the carry trade, where US would take the stronger dollar and they'd buy weaker Japanese yen, and they'd use that yen to buy JGBs or other assets, companies, stocks, etc. And it's gone back and forth. Well, that lasted because Japan had kept their near zero policy for about, what, 30 to 35 years. And it lasted really until the great financial crisis, and maybe into about 2011, 2012. Because at that time, we had 2009, we had the Arab Spring. The dollar got down to 72 on the GDX or the GXY, the global dollar index. The yen got stronger. The carry trade just wasn't. And for many people and those on Wall Street, the carry trade with the yen was over. But things changed. As we got into 2018, the Fed, the repo markets, we had the COVID, we had a lot of things. The dollar got artificially stronger against most currencies. And guess what has happened over the past 6 months? The Bank of Japan has had to raise rates for the first time in 40 years. And they've done it twice now. Well, they did it on Friday. So going into the weekend, we saw Japan opened up on Sunday night with the worst drop in Nikkei history, because the yen carry trade, which is estimated to be a $20 trillion derivatives market, what are they going to do? You are seeing margin calls, because that's $20 trillion, but it's all leveraged out. And you saw margin calls, and this is why it carried over to Europe, carried over in the US. You mentioned gold, everything sold off. Paper gold sold not because gold was doing bad. Gold should have gone up because of the geopolitical fears going on in the Middle East. But it was the paper markets that sold because they were shorting, they were trying to do anything to get cash to start covering margins in their equity and bond holdings. But there's something else to take into consideration. The bubble that has been created over the past year in AI and NVIDIA especially, that news came out because they did their earnings and they waited until the markets were closed, and NVIDIA suddenly says, oh, we're not going to be able to get our next gen chips out because they're just not well yet. Boom. You're seeing the AI bubble crash. You're seeing all these different things happen at once. And so that's what I mean. There was intervention in the Bank of Japan. They had a meeting yesterday evening, and we saw, wow,
Hello.
like problem is the leverage. The problem is,
we lost
yeah,
you there for about 30 seconds.
yeah. I think the internet probably did that anyway. To summarize where I got maybe cut off here, the fact of the matter is that the leveraging globally in all the currencies, all the arbitrage, all the carry trades, all of this are starting to come all at once. And what you said was vastly important, is because people weren't going into the dollar. They weren't buying treasury bonds. They were looking for alternatives, and the Chinese yuan was a big one that they moved into.
Well, yes, and ironically, in this also the yen got to 142. Okay, yes, that's part because of the fact that it's not really that surprising in one sense, but I generally, yes, it absolutely relates to the carry trade for sure. And the carry trade, well, okay, there's arguments about how big it is. It could be even bigger than 20 trillion. Certainly, the argument is it's blowing up, and everyone's therefore, there's also huge liquidity problems, margin problems. So, yeah, everything gets blown up. Although the argument is we saw a recovery of sorts today. But the question is this the start of a more serious problem? Is there other things brewing below the surface? And I do believe there is. I mean, if you look at like US corporate investment grade bond spreads, they've been spiking for the last month or so. And also with high yield bonds, almost spiking symmetrically with corporate investment grade. These are indicative problems. So I'm not doubting that there were the jobs data for me was a cover for the carry trade blowing up. Have they sorted all those problems out? Well, there's no doubt as things blew up, the ESF would have stepped in, so-called plunge protection team, and tried to shore everything up that needed to be shored up to make sure that nothing catastrophic happened. But is this indicative of broader problems? It might well be. We won't know at this point in time. The other thing I think worth mentioning, Ken, is what happened with the VIX, because that also spiked enormously. I think at one point it was up in around the 50 mark, 52, I think 53, had risen over 100%. Now, okay, it's softened a bit today, but it's still higher. So let's wait to see what happens in the next week, few days, the rest of this week, wherever, and see if that's an issue. And the other thing I think worth mentioning is that we had, if we look at the 2-year US Treasury, clearly since probably May/June time, it fell from the yield from about 4.8%, and it fell to about 3.7. That started to move back up to 4%. So, is this indicative of yet more turmoil in the bond markets and volatility? And I think that's one of the important points to make, is just the extent of the volatility we're seeing. I mean, and of course, the question is the Fed going to be forced into cutting interest rates sooner than the next FOMC meeting? But I don't suspect they will do. But we've got auctions this week. I think there's one over 40 billion for the 10-year, which is tomorrow, and then a 30-year 20 or 25 billion issuance Thursday. It would be interesting to see what happens to the bond markets, because remember, at the end of the day, the bond markets aren't worth paper they're printed on, so to speak, because it's clearly all this idea the foreigners are buying US Treasuries. They're absolutely not. There's certainly been a shift of buying Treasuries from the long end to the short end. That's self-explanatory. But I think what's interesting is, and I wonder how many of these high net worth individuals, as much as they may have cash at hand now or cash equivalents, how much are these also holding short-term Treasuries? Meaning it's not foreigners buying it, but they're plowing into the market as well. And this explains, maybe to some extent, why we're seeing this spike in cash held by certain financial institutions or financial or individuals. Okay, yeah, there are individuals who are dumping stocks, so yeah, their cash pile grows. And why is the cash pile growing? So it'd be interesting what happens now with the Japanese. I mean, but also the other question with all this is, who is taking advantage of this carry trade? And is who's participating in this carry trade? And the other fundamental problem we have with equity markets is the fact that there is so little liquidity, there is so much volatility. But we definitely saw huge amounts of volume trading. And just a point worth making about the Neckey, which actually not just in relation to what happened sort of Monday Japanese time, where it fell about 12%, but the Nikkei lost, has had previous bouts in the last 30 or years or so of losing 20% or more within like a 3-week period. And Larry McDonald did a tweet, if anyone knows him, or a post as it's now called. So give him credit, because he produced this, and he made the point, if you go back to 1990, in a spell from mid-February to early March, it fell 21%. Obviously, post-Lehman, no surprise, it fell 23% from late September to the middle of October. And in 2013, it fell 21% from the sort of third week of May to roughly 21 days later, middle of June. And then obviously during the pandemic, it fell 23% from kind of February the 21st to March the 13th. So what we're seeing is not unusual. Okay, and there are reasons, sometimes more obvious reasons, sometimes less obvious reasons. So there has been that kind of volatility. but it does, I think, significantly point to the issue of this kind of the carry trade, and how that really is effectively the end of the lines come. And there's no doubt, I suspect, everyone would have been lined up going, look, we're going to announce an interest rate, right? You got to understand what that means. And everyone would have been prepared for what was coming. But I think it very conveniently is a good opportunity, because they've been doing everything to battle to suppress the price of silver. Particularly 31 was a very obvious. Every time it got to 31 or over, it was getting smashed back down. Gold, less so, but I think it's a perfect opportunity to try and cause some serious damage to the paper price, particularly silver, which is now currently at about $27 a barrel, dollars an ounce. But the other thing I think that's worth mentioning, and this may be a bit of a surprise, but it also is very indicative of fears of recession. So again, we're back to the point, is recession playing a part in all this? And most certainly it is. But if you look at hedge funds, they've actually really now become quite bearish on commodities futures. And why is that interesting? Because it's the first time it's happened in over 8 years. So they've got net contracts where they're betting now on lower prices. That's roughly, there's a basket of about 20 commodities. I can't tell you off the top of my head exactly what they all are, but for 8 years, they were net, net positive on the price rising. Now, typically, if you become bullish and then bearish, it's because you fear economic slowdown, and these commodities will obviously suffer a much lower demand. Therefore, the price will fall. Now, okay, it doesn't necessarily mean anything specifically, but it is, again, another indicator. And for me, the United States has been in recession pretty much all the time since 2008. I mean, if you actually strip out all the nonsense in all the data that's produced, the US has been in recession. But the idea now that the United States isn't in recession is really a myth. But so therefore, I think in a broad sense, this could as much be as well as trying to put some pressure on the Fed to lower interest rates. But we're back to the thing. The Fed raised interest rates to protect the dollar. It's got nothing to do with, they're prepared to as much as they can, to sacrifice everything, because except the dollar, because the dollar has to reign supreme. But the dollar isn't panning out the way they expected it to. I mean, and I'm not a big fan of the dollar index in any way, shape, or form, but the dollar index has been taking a kicking, and people go, oh, well, that's because the belief is the Fed's going to lower interest rates. Well, if you look at when the Fed started raising interest rates and to where it is now, given what interest rates are at, it doesn't support any strength in the dollar, because you'd have expected the dollar index to be way higher than it is now, but it isn't. And of course, I think it's very interesting, as you made the point, Ken, when we said before we came on air about the move into the yuan. And the question is that indicative of something, if there was broader concerns, or does it relate in some way to the carry trade? I don't know, because I don't operate in that market, don't know who's involved, what they're investing in, and who's hedging what against what. But it remains to be seen, I think, what happens. Is this the carry trade problems being dealt with? I'd be surprised if it got dealt with in a single day, but maybe it did. I don't know. But is this indicative of broader problems? We're in that interesting window of August going into September, but at the moment, I don't. I err on the side that it's more related to the carry trade, but we'll see what happens in the coming weeks and the remainder of this week. And but as ever, the biggest problem is all data is just total manipulation. All markets are manipulation. They bear no resemblance to reality, so it's very difficult to make any valued assessment when you see markets move in a certain way. But there is absolutely no doubt that there was panic and certainly market intervention. But I mean, if they can deal with the problem in 24 hours, 48 hours, it's something they can live with. But another point worth making, and it bears out what we've always said, when equities get smashed, Bitcoin gets blitzed, and that happened, they went below 50,000. Yeah, it's bounced back to 55, 56. Again, what a surprise. That's getting pumped back. I mean, okay, there was some issue with the US government dumping Bitcoin. Obviously, they confiscated. So much for governments not being able to seize Bitcoin and control the market to some extent. Again, another myth shattered, which along with many others, but it's very indicative that Bitcoin moves based on equities. So if equities get hammered, so does Bitcoin. Well, the question is, in future, if we have a proper full-blown recession or worse, and the economic data and indicators around us and equity markets get smashed, then you would logically think Bitcoin will get blitzed as well, but time will tell. But logically, I think, and we followed this has been the case for a number of years. I tweeted about it 2 years ago, saying it was a problem then. So I think that's what I mentioned. But I think for me, the interesting parts can be what's happening in commodities markets, what happens on bond spreads, what's happening in the bond markets. Is there any indication that this is a more serious problem, or is it just, hello, we've had a problem with the carry trade? But then here's the question, and really the carry trade has allowed the Japanese government to effectively have very high debt to GDP. It's allowed them to be able to basically bluff their way without any real economic growth, etc. And if that carry trade ends and it's no longer not a possibility, what are they going to do to finance the fact that they have a bloated debt to GDP? They've got huge problems with their economy. I mean, because without that, the question is, what happens in the future? I mean, are they going to have to again revert lower interest rates and just print like there's no tomorrow? Because the carry trade did help them. It certainly helped their fiscal position. There's no doubt about it. I mean, and the question is, what happens for Japan if they're not going to have structurally higher inflation? And that remains an ongoing problem. So, because if they do, the argument's going to be, well, you'll have to continue raising interest rates. Well, if they continue to raise interest rates, what's that going to do? I mean, it just, when you've had zero interest rate policy for as long as they've had, it's a huge problem. So, if this is the unwinding of, the sort of carry trade, which is probably the only major one that's left, where they've been able to really weather the storm in a very advantageous way, which is why they never really wanted to raise interest rates. They've had no choice. And if they have to continue, then they're just going to blow everything up and it'd be the end of everything. And then the question is, what's the contagion risk? I mean, we saw on Monday, I think when the markets closed, you've got Mitsubishi Bank. It's the 9th largest bank in the world, based on assets. And its share price got hammered. So it's about 20% down. So the question is, what's going to happen for Japanese banks? What's the contagion risk? And how inextricably linked are they to the Western financial system? And that's a very difficult question to answer, but certainly Japan's teetering on the edge. And I think the loss of the carry trade will be enormously damaging to them. It will certainly weaken their fiscal position. It's going to, obviously, in monetary policy terms, that they're going to have to revert and lower interest rates again. And then what's the longer term prospect for the yen? But they do have room. They do have an enormous amount of treasuries they can dump, but that only provides temporary relief. But again, if they have a stronger yen, are they going to do everything to defend the yen? Or because if you do everything to defend the yen, you're just going to destroy what's left of their economy, etc. So it's very interesting to see what happens in that regard. It's not clear at this point in time. And we just have to observe. We can make some observations, what we've seen in the last couple of days, but it's impossible to say what will happen because there are so many moving parts and also just so much data manipulation. But this could be something in the next few weeks we reflect upon and go, that was one of those moments where something happened and it was hiding something far more significant. Maybe it's not just hiding the carry trade, but something far more fundamentally important as well.
Yeah, I think in the at least on the surface today, something caused the Bank of Japan to have to raise rates twice in the last 6 months, something they haven't done for nearly 40 years. So what caused them to do it? The only thing that stands out right now is the rising inflation that was taking place in their economy. Now, there could be more underlying it, but I think that really, at this point, is the one pebble that was thrown into the pond that really disturbed everything. Now, obviously, when you talk about the dollar and the dollar index, you could almost call it the Swift index, because that's really what it does. Is every, those in the dollar index are tied to Swift in relation to their local currency, the strength, et cetera, et cetera. But that's for another day. I think, though, we did cover, because everything that we've got going so far, we don't know what's going to happen in the future. Is this just an anomaly? Is this short term? My conjecture is that the Fed is sort of in a bind, because they really do not want to get rid of their perceived independence by doing some major rate hiking or rate cutting and anything else just 3 months going into the election to be seen as political. So that's going to hinder them up to a great extent. And if that's the case, if we're already sliding well into the middle of a recession, I agree with you, we're in a recession, but into a middle recession and things get worse, they're going to be forced to have to do something of significance, whether it's to protect the banks, the hedge funds, who knows, or even if they decide to pick a side when it comes to the politicians. That we will see in the coming days if it comes to fruition. Anyway, Paul, I think we covered quite a bit of what's transpired over the last 3 days. Any final words you want to add, or do you think
No,
that
that's fine. I mean, I think this is one of those things. There's a lot to discuss, so we'll have to, pick and choose. Otherwise, you can talk for hours and it'll bore people to death. So let's park it for now. If we see some individual specific things worth discussing, then we can come back to it.
Yep, we always have a new podcast to do. So anyway, Paul, thank you as always for being as part of the conversation. And to everybody here, thank you for being a part of the community. And we will see you next time.
Yeah, and thank you, Ken, obviously, because without you, it's pointless doing this. So, and all your input, and obviously to everyone who's listening and subscribing, thank you very much. We greatly appreciate your support. With that, I'll say goodbye.